welcome everybody to the Legacy Wealth Show podcast. I'm here with a good friend of mine, Josh Cantwell. I've known Josh known of Josh, and we've known each other for several years. And pretty much I got started in real estate investing, we're from the same hometown. He actually lives like a mile behind me, maybe less than that, right?
Yeah.
We've been doing deals together for the past couple of years now, and do a lot on the front of Josh is phenomenal at raising private money, and he's really good. I'll let him share his story, but he's really good at raising money and investing money and underwriting deals and getting your money working for you, right? And figuring out, you've done an awesome job at figuring out how to like arbitrage different capital and through the fund and all that kind of stuff. So why don't you give a brief background on yourself, Josh, kind of where you started and kind of how you got to where you are now and what you have currently going on. And then I know you got a lot of meat and potatoes that we're going to dive deep into. And then we're going to have an awesome conversation too, brother. So appreciate you being here.
Yeah, absolutely. So thanks for having me on, man. This is fun as always, spending time with you. And for, your members and your audience that doesn't know, Tim and I put together several big multi-million-dollar apartment projects. And Tim's house is a beer and a half walk.
A beer and a half, that's what it was.
It's a Coors Light and a half walking through the woods to the neighborhood to get from my garage to yours. I've timed it a couple times back and forth. So
perfect.
So on a serious note, I got started in real estate because I was a financial advisor. And this is going back to 1997, 1998 to 2004. I managed about $30 million of money in traditional investments, stocks, bonds, mutual funds, life insurance, did estate planning. But I noticed most of my most successful clients did not have all their money with me in the stock market. They had their money in rental properties. They owned buildings. They owned restaurants, multifamily. Nothing to the size that you and I have done, Tim, but I got a sense of what real estate could do. And when I was trying to sell them on the next mutual fund investment or the next IRA or the next life insurance, strategy, they were selling me on why they shouldn't do that and why they would invest in their next, multifamily or their next rental property. So I took notice. And, like a lot of people, I started with, very little of my own money, kind of had to bootstrap it and be very resourceful, figuring out how to afford a new business. And I started with a business partner. We hired our first assistant right away. So we had overhead right away. But we got very resourceful finding deals, and we essentially wholesale properties, and we did short sales and wholesaling and some REOs, some rehabs, all the way from 2003, 2004, all the way to 2010, 2011. And then I got sick. I got sick. I was diagnosed with pancreatic cancer and had to rethink my entire life because not only was my life at risk, truly at risk with 3 small kids, but I also realized that my business was 100% dependent on me. Putting on my pants, my boots, my shoes, going out and doing deals. We had a great team. We had software. I was an original founder of RealFlow, the RealFlow software with my friend Greg Clement. We had software. We were adopting automation strategies. But if I didn't show up at work, things just slowly fell apart, like a lot of business owners that don't have automation systems or standard operating procedures. And when I got sick, I was torn away from my business for about 9 months. I actually counted from like the late 2010 to early 2012. I only worked like 100 days out of almost 400 days that I could actually work. And so, to kind of round out that story and where we're at today, I bought a couple rehab flips when I was going into the hospital for this massive surgery. And I bought them. I worked with a JV partner to have them outsource the improvements. And I disappeared and went into the hospital and went into recovery for about 4 months. And I only saw these properties 2 or 3 times. We raised all the private capital. And when we sold them was in April 2012. We made about $35,000 on one flip and $40,000 on the other. And Tim, I got to tell you, like, the money came in right when I needed it the most, man. Because although I was very successful, all of a sudden I had all these medical bills, and I had a business that essentially was failing without me, and I had to let people go. And I didn't make a whole lot of income for like 9 months because I was dealing with all these doctor's appointments and surgery. And I thought to myself, like, hey man, what if I could just do that again? What if I could raise the capital and control the deal by controlling the funding. And that's really become my focus for the last really 6-7 years is funding equals freedom. Funding gives you control. Funding gives you the opportunity to control an asset, an apartment, a rehab. Controlling the funding controls everything. You can control the contractors and their pace of movement. You can control your JV partners, how people get paid. And you can get yourself involved in a lot of deals if you have access to true private money. Now, I'm not talking about bank financing. I'm not talking about, institutional private money like Lending Home or Lima One or those companies. I'm talking about truly raising your own money. And that's really what I've become an expert in. And hopefully share some strategies around that today with your audience.
I love it, dude. And that's definitely your skill set. And it's one of the things that I've kind of realized too. I travel a lot. You travel a lot. You guys do coaching. I do coaching. And what I've noticed is when you travel to any major metropolitan city across the country and you look at the biggest buildings there, right? All the skyscrapers there, they're all owned by banks and insurance companies, right? So that tells me and insurance companies are essentially banks, right? They're getting people's money and then they're redeploying it out. Like I have life insurance companies that lend me money and invest in projects on our apartment buildings. And so I noticed and realized that there's something going on. These banks know something. By controlling the money, I realized that finance is the industry that commands all other industries. And like you said, you can control everything, all aspects of the deal, all aspects of your business, all aspects of joint ventures, if you can control the money. And there's a lot of juice in the squeeze if that's really your forte. And that's what you're awesome at, man. So tell me about what you got going on today, and then let's bridge the gaps on how you got so well, how you got so good at raising money and some of the strategies and tactics that you use, because I know you got some ninja stuff back there, man.
Yeah, for sure, man. So today we really focus on a couple things. So we have a private equity fund we've raised money into. It's a debt fund, and we manage that fund, and we lend money out primarily to residential and small commercial investors. And we're primarily the first mortgage holder. So I used to borrow tons of private money for my own deals. I still do. But I had so many people coming to me saying, hey, Josh, I've had such a good experience investing with you. I have more referrals. I have friends. I have more money. And I got to the point where I didn't need all the money for my own project. So I started a private equity fund, and that fund owns debt. It owns private money loans and hard money loans. And we created an amazing return for passive investors that just invest in the fund, and the fund owns all this debt, all this paper. The second thing we do is we fund and lend on what we call one-off deals. And these could be rehabs or small commercial, small apartments, really in the $250,000 to $2.5 million space. And in this area, we're, again, primarily the first mortgage debt lender, but we're closing essentially either rehab loans or we're closing bridge loans. Sometimes they're 6 months up to 3 years, typically on small commercial, and a lot of value-add apartments, just the smaller stuff that you're used to seeing. So we do that. We do that really big in Ohio. We really have a big footprint in Northeast Ohio, but we do fund deals like that all over Ohio, and we fund deals, smaller rehab stuff all over the country. So that's the second thing. And we do those on a one-off basis outside of our fund. And then third, we bring equity into deals. We raise capital, and we take an ownership stake in larger deals, a lot of value-add apartment stuff. And we've joint ventured with you, Tim, on a number of things. We've joint ventured with other guys, and we're looking with really good operators who know the business to invest with them, be a strategic advisor, underwrite the deal, and then, bring some of the capital that we have access to that transaction, and become a long-term equity owner, joint venture partner in that deal. So that's really what we're focused on, those three things right now. And Tim, I've done about 700 deals myself, about 400 wholesale deals and about 300, rehabs and rentals. I also have made about 400 private lender loans on top of that. And today, my love is in the money. So I'm not like the operator, the boots on the ground like I used to be. I'm taking the capital of my own money and other people's money that I control, and we're investing that with really amazing operators. And that's just what we found our niche to be. I know if we were the operator and we found the deal, we structured the deal, we rehabbed the deal, and we managed it, we could own a lot more equity in those transactions. But, you know, a friend of mine told me a long time ago, he said, only do what only you can do. And so, you know, I know one of my, you know, niches, one of my sort of ninja skills is raising money and networking with people. So although I could go look for apartments and commercial deals, I'm really focused just on money relationships and helping operators like you, Tim, and a lot of your students and other people, help them get more capital in their capital stack, whether it's debt, whether it's equity.
I love it, dude. And yeah, I mean, one of the things that I found is, you know, everything ebbs and flows, right? So it was like today, it's very hard to find deals, a little bit easier to find money compared to, you know, 5 years ago. It was really hard to find money, real easy to find deals. All you had to go is hop on MLS or on LoopNet, and you could have your pick at any deal you wanted. But everybody's saying run away from real estate, run away from whatever. So it was harder to talk to people about putting money into projects versus today. Again, no deals on MLS, no deals on LoopNet. You got to find everything off market, but everybody doesn't like the volatility that's in the stock market right now. They want their money out. They want it in something tangible, something that you can see, feel, and touch. And a lot of this money is coming out to alternative assets like apartment buildings and single family rentals. So talk to me a little bit about the psychology that you're finding in a lot of your investors. What's really cool is I like that you don't offer, hey, this is the investment, yes or no. Instead, you say, here's our 3 types of investments. Which one do you want? So now you're going to do business with us one way or another. It's going to be in one of these things instead of yes or no. Are you doing business with us? Talk to me a little bit about the psychology of the investor. What are investors looking for? Like, how come some people can raise money so well and some other people have such a difficult time with it? And tell me what you see from your end on some of the. I know you have kind of like a process that you go through in order to raise money. We can dive into that in a minute. But is there a psychology that you're seeing that why some people are really good at raising money and others aren't?
Sure. I think, Tim, first of all, I think it's knowing your competition. It's knowing what you're fighting against. And the fact that I'm a former financial advisor, I had my Series 6, my 66, my 63. You know, I had these years ago. I let these licenses lapse like in 2005, right? But I knew what every financial advisor was trying to sell. And they're all trying to sell this one sentence, this one philosophy, which is diversify and wait. And so if you know what everybody else is buying, all your average investors, you know, guys could be accredited, they could be non-accredited, but your average person could be making $50,000 a year, could be making $500,000 a year, could be your average doctor, could be a teacher, whatever it is, their normal financial advisor is telling them diversify and wait. And if you look at this is where it comes from, it's just, Tim, hard facts. My belief, my passion for this just comes from the stock market, the hard facts. When the stock market was founded by J.P. Morgan, essentially in the early 1900s, I know you're a big fan of that movie, The Men Who Built America, right? Yep. There's a whole section on J.P. Morgan, founder of the modern day stock market. The proof is in the pudding. The market, if you're in large cap stocks, S&P 500, Dow Jones type stocks, you're going to average a 9% return over the long haul. It's averaged 9% for the last 100 years. It's probably going to average 9% for the next 100 years. A blended portfolio, meaning you average in some bonds and some cash, it's going to drag down that return down to about a 7%. Now that's a gross return. That's before fees, before management fees, 12B1 fees, marketing fees. And your average investor is investing in mutual funds in their 401k or in their accounts, or even in a life insurance product, or even in a variable annuity product. They're investing in essentially mutual funds. And Forbes did a study, Tim. It was in Tony Robbins' book. It's been in many different books, where the average mutual fund carries about 3.14% in total fees per year.
Wow.
Okay. And that includes sales commissions, it includes management fees. But there was also independent studies done that said that your average mutual fund has what's called an expense ratio. That's the one fee that everybody talks about. Well, the average mutual fund actually has 12 different fees baked into their prospectus that they don't immediately and obviously disclose. So the expense ratio is what you see on Morningstar or what you see on Yahoo Finance, the expense ratio, but there's 12 more fees baked in there somewhere. So your average investor is getting smoked, with a 7% blended return and 3% in fees. Now, some guys are going to say, well, I only invest in index funds. Well, great. I definitely clap it up for you because that's the better move. But even if you did a blended portfolio with index funds, you're going to get about 7. So I think, look, if my investors in real estate or the average passive private lender or passive equity investor in real estate, they're looking to get a minimum of 10, a minimum of 12. Mm-hmm. And that's after any kind of fees or commissions. That's net. That return is so much bigger and it's so much more powerful over a 20-year period that's where it comes from. It's just the facts. And, if you're not getting a 10 or 12% return, there's so many different ways. Tim, you and I both know. We both have amazing friends and affiliates who are investors in crypto and cannabis and real estate and oil and gas. I mean, a 10 or a 12 it's common in the alternative space. Mm-hmm. The reason why it's not prevalent, right, is there's nobody selling it. There's no commission. There's no Charles Schwab. There's no MetLife. There's no Merrill Lynch peddling our stuff. Yep. Because it's all in the private placement world. So really my passion for it, the psychology comes from that, what I just described, the difference between those two. And now I have a 15-year track record of seeing the difference between those two. Mm-hmm. I'll kind of wrap up this part of the discussion, Tim, with this. If you look at the last 5 years from, 2014, 15, 16, 17, 18, that 5-year run, everybody's like, oh my God, one of the greatest bull runs ever. Sure, true. Yeah. But if you looked at just the S&P 500 over that time frame, it averaged about, even in this great bull run, about a 10% return. And if you factor in your fees, you're net 7. And that's in one of the best bull runs ever. Yeah. And I know that whole time, I've either been borrowing money at 10, 12%, or I've been investing money at 12, 15, 20%. And so even in the best of the best times for the stock market, our real estate investments are crushing that stuff.
Dude, I believe 100%. And it goes back to, how we buy deals and how we're structuring deals and the operators and all that kind of stuff. But like, I just went through this with my life insurance guy, and, I'm like, hey, I got a whole life policy and this and that, and looking at my financial advisor and looking at some other stuff. And they kept on coming back to this phrase of saying, hey, it's the cost of the investment. And I kept on thinking, like, it's so friggin' counterintuitive. Like, it's not counterintuitive. It's so backwards that there's a cost to an investment. Like, that makes no sense to me. I would never charge somebody to invest in one of my projects. You know what I mean? Like, I feel like the traditional finance realm is so backwards. And that's why everybody, hey, whether you like the guy or not, like, Donald Trump is very direct and very like, you can't bullshit them, all that kind of stuff. And I think that's what people are looking for. They're looking for that genuineness, that authenticness. And yeah, the guy's sometimes a buffoon and says a lot of goofy stuff, but at least he's authentic. At least he believes in himself, and he'll say it as it is. And I feel like a lot of investors are going through that right now too. I'm saying, dude, I'm tired of having a cost on my investment. I'm tired of people telling me that, oh, this is normal. And I think a lot of people are going to alternative assets and real estate and some of these other things because of that. I think they're tired of the, getting smoked by the traditional finance system. So, yeah. No, man, great points.
And technology, the way it's worked with Uber disrupting, the taxi cab industry and Google Alphabet disrupting like everything we do, and Facebook with all of its disruption. The truth is crowdfunding is that disruption in the real estate world. Mm-hmm. Your average investor can now, they can be accredited or even in some offers non-accredited and invest small amounts of money with little or no fees. They can invest, $2,500 in some of these crowdfunding offers. That's the disruption that people are now seeing on a small level. They can do their own due diligence. They can go to a crowdfunding platform and get really good data information with zero fees, right? Yep. That's the disruption. And that's only going to get worse. It's only going to get better, honestly, for us. because it's going to open up the conversation bigger and bigger and bigger and bigger to say like, well, like stocks and bonds are not all that's there. Like this is not mommy and daddy's investing, right? Mm-hmm. This is the new way to invest, and you can invest in private placements and small offerings. And obviously some of them are big. Like some of our stuff, you got to put in 100 grand, 250 grand is the minimum. Sometimes that's the deal, but there's other times when an offer, you could do stuff on a small scale, but the information is so available now, it's easy to, debunk a financial advisor. Mm-hmm. And similar to you, Tim, I have a financial advisor. He's a friend of mine. It's actually a guy that I mentored when I was in the financial services industry. I stayed in touch with him the last 20 years. He's an amazing guy. His name is Bratz. He's from this area. And he's with Lincoln. And I only pay him to write a financial plan for me and my wife. I don't buy any products from him. So he does like tax planning, forecasting, projections, like risk diversification allocation, but I buy zero products because I told him, look, I'm going to diversify within real estate, commercial, residential, a fund, a one-off deal, a residential, a fix and flip, maybe a crowdfunding investment, diversify that way. Because I know real estate's the way to make money long-term. It outperforms the stock market. So I'm not going to diversify by owning bonds and stocks and all these different things. I'm going to stay in real estate 100%, but diversify within real estate. That's been my avenue to go.
I love it, man. I'm the same way. Every time I've ever gone, hey, I got a hot stock tip, go and buy this stock. Friggin' plummets by 90%, lose all my money. Like, what am I doing? Stop doing it, It goes up. And you have, what's the, we were talking, the other day about how many people are investing in PPMs versus in IPOs, right? Isn't there like a stat that you were sharing on that the other day?
Yeah. Since 2010, there's more money raised, more investors investing in private placements, which are like, my fund, Tim's Apartments, those are private placements. More money invested in private placements than IPOs every single year since 2010. Wow. So we're going on now 9 years where like recently Lyft went public and Pinterest and Uber's going to go public. But more money is raised through private placements than these big, sexy, newsworthy IPOs. And that's just because that's what's sexy for the news to talk about. But on a day-to-day basis, Uber got its start with a private placement. Lyft, DoorDash, all these companies are starting with private placements, and then they're going public. So it's massive, it's huge, it's not going away, and the more people are getting exposed to it, which is great for us.
Love it, man. So, dude, you are a ninja at raising money, and I know you have like a phenomenal process, and some of the you go through some of the psychology as we've discussed in the past at some of my events too, about how you raise money and kind of what that all looks like. Can you go through that? I know it's a little bit, but I think it's so valuable, and I'd love it if you could share that.
Sure. Yeah, it's a 5-step process that I use, and this doesn't matter if you're raising money for your first fix and flip or your first value add apartment, maybe a 10 unit or a 25 unit, or you're raising money for a fund, or you're raising money for a massive apartment deal. It comes down to really 5 things. And so I'll cover these kind of real quick, and then we could do a deeper dive if we want. But the first step is you have to craft an irresistible offer. Okay. When I look at raising money, I want an irresistible offer to be something that when I present it to an investor, they're going to say things like, oh my God, why wouldn't I do that? Like, I want that to be their initial reaction instead of like pondering it and saying, well, that's okay, but I got a lot of other options like that. So craft an irresistible offer. The second step is you got to know exactly who your avatar is that you're going after. Who is the exact age and career, job description of that person that you're going after. Knowing that, because the thing is, if you raise money from a certain type of person, let's say it's a 60-year-old corporate lifelong guy who's retired. Okay, if you know that's your avatar, it's going to be much easier to start with that and then have that spider out. Right? Instead of just saying, I'm going to raise money from everybody. So know who your avatar is. The The third step, Tim, is you've got to know exactly where you can locate your audience. What events, what places, what industry functions does your audience hang out at, right? So if your audience is doctors, where do they spend time? If they're corporate lifers, where do they spend time? If they're retirees, where do they spend time, right? So knowing exactly where they hang out at. The fourth step is to have a multi-medium marketing approach to follow up with that audience. So once you make those connections and they're now in your database and you have their phone number, their email, etc., is to have a multi-medium follow-up marketing approach. So they see that you're everywhere. And this is something that we talk about in my business every single week during our marketing and sales meetings is how can we be omnipresent? So they're hearing from us on the phone. We send them text messages. They get emails from us. They see Facebook ads if we're doing Facebook ads. They get newsletters. They get like investor appreciation gifts. We're out at speaking functions, multi-medium approach. And then finally, step number 5 is to follow a proven sales process. And what I mean by that is that when I have my first meeting with an investor, it's always the same. I ask the same questions every single time. And my follow-up after the first meeting is exactly the same every single time. I send the same exact email follow every time. Then my second meeting, it's the same exact line of questioning. It's the same discussion every time. And obviously, depending on their questions, it can go a little bit down a bunny trail here or there, but it's the same, what we call that step 2. Then our step 3 meeting is when we actually present the offer, and then it's the same follow-up process. So we actually have an 8-step, so step number 5 in that was follow a proven sales process. That little step 5, has 9 sub-steps of exactly what we do every single time. So I have a repeatable process that my business development guys can follow. And so it's those things: irresistible offer, avatar, where's your target audience hanging out? Start and follow up with a multimedia marketing approach, and then follow a proven sales process. Because sales is sales, but if you let your guys, whether it's you or business development guys, kind of run off like wild herd of cats trying to raise money, they're not going to be as successful. But if they follow that same proven 5 steps, especially step number 5, once we're on the phone with somebody, we have a much larger likelihood of getting money from somebody and having them invest.
It's powerful stuff, man. And it's simple. It's one of those things where once you create the system, you can follow it forever, right? It's not like you're reinventing a wheel. Like, you understand what this looks like, what the process looks like, and what the conversations look like. And then when you follow a proven system, you're having the same conversations over and over again, which means you're getting better. Somebody else might hear your conversation for the first time, but you're hearing your conversation for the 10th time or the 50th time or the 100th time. And you're getting better and better and better at crafting your conversation because of that. You know what kind of objections they're going to come up with. You can address those before they even bring them up, So it makes you better at your craft by having a proven system. Question: irresistible offer. When you say create an irresistible offer, do you ever have any backlash? Because now people are like, well, this is too good to be true, kind of a thing?
Yeah, for sure.
And how do you combat that?
Yeah, we sort of want them to think this is too good to be true, because I'd rather have that reaction than
not good enough, right?
Okay, I can get that anywhere reaction. But some examples, and again, this isn't an offer for anybody who listens to this. I'm not asking you to invest in my deals, but I'll talk just quickly about some past type of arrangements that we've had. So on a fix and flip, what I found is I started doing and playing with my different offers, and I landed on where I would tell my investors, hey, I'll pay you 12% interest on your money or 15% of my profits, whichever is higher. And it's, a 1-year investment, it's a 1-year balloon, but they would invest and I would defer all the interest payments until the property sold. So it was good for me. It was real good for cash flow. And they were like, well, yeah, why wouldn't I do that? 12% minimum, no fees. So it's a true 12%. Or if 15% of Josh's profits is better, then I'm going to get a higher return. So I've had a couple guys where I, fixed and flipped the house really fast, and their internal rate of return was like 24% return. Because we returned the capital quickly to them and they got a piece of our profit and their returns were in the 20-30%. So when they first hear it, they can have that sort of, this is too good to be true. But I tell them, listen, I'm acquiring these properties at roughly 65 to 70 cents on the dollar. So I've got 35% profit or equity. So if I buy a property, I'm all in for 200 and I sell that property for 300, if my net profit is 60 grand after all my costs, if I give you 15% of that, it's only $9,000. I've still got $51,000 left for me. So when they just see the math, and I tell people all the time, like my daughter's in 5th grade. Real estate is 5th grade math. And if you can understand that, it's just devastating logic. It's devastatingly simple. They just have to understand we're buying properties at wholesale prices. We're not paying at retail. So you've got to be able to make the offer and then follow that up with how the numbers, the simple 5th grade math, proves that we can do this. It's not too good to be true. It's just 5th grade math.
You know what I'm thinking of is, and I kind of fell into this the same way, the way that I structure deals, and we've done a bunch of deals together on the commercial side, is investors like to know exactly what they're going to make on a property, but they still want some upside potential, right? So they want to have predictable returns on their investment, but at the same time, Josh, if you're going to get rich and I helped you get rich, isn't it only fair that I get a little percentage of that too? And so I kind of fell into the same thing in the way that we've been structuring all of our deals, with the fixed pref payment along with equity on the back end that they keep in perpetuity has been massive. And it's because one of the things I get is it's too good to be true. Like, what's the downside risk? What if this happens, or what if that happens, or what can go wrong, kind of a thing. And you bullet point it, and you explain all the logic behind it, and it makes a lot of sense. So it's powerful. What have you seen? Speaking about our deals, why have you liked, or why have your investors, do you think, like some of the projects that we've been doing together, as opposed to investing in the stock market, or going and investing in their own projects, or just lending on a debt component to somebody else? Why do you think that we've had a lot of success with Legacy Wealth Fund and a lot of the things that we're doing together?
Yeah, well, it's a similar concept to what we just talked about. If you have sort of a pref, or what's perceived to be a floor, a minimum, again, it's not guaranteed, but it's a pref payment. They get that payment first, or they get paid before we get paid. And then if the deal goes well, there's upside. If they're looking at, a 10 or a 12 or some sort of return in that area, which most of the deals I've done and most of the deals that we've looked at with you, Tim, it's like, we always want to start our investors where they can be, in that range. And that's kind of their, again, not guaranteed, but their perceived minimum is that. And then it's the upside, right? So I can be an equity owner in this deal in perpetuity, or I can have upside if I flip this property fast. Or it even works for rental properties where, you pay somebody, let's say 10% return during the stabilization phase on a single family or a multifamily small commercial, and then refinance it and leave them in the deal for 5 or 10% of the equity in perpetuity. Everybody likes to go to Vegas. Everybody likes to gamble. What they don't like to do is lose, right? Yeah. People will say, well, I don't gamble. Well, what if you knew that you could win most of the time? Then would you gamble? Hell yeah, right? Yeah. So it's not gambling if the numbers all make sense. But so what people perceive to be like, remove most of my risk by having a physical asset, remove most of my risk by having a good operator and buying the property at a wholesale price. And then the pref payment, okay, great. I know I'm beating the market, so check that box. And then give me some juice on the back end. And then it's like, okay, this is just, why wouldn't I do this, right? So yeah. Perfect example, like I'm actually recording this from my home office, and down the street, there's like 4 Browns players that live down the street. Matter of fact, today's Chris Hubbard is our left tackle.
Yeah.
He lives on the corner, and he's got like the happy birthday Chris, like stuff in his front yard. Yeah. I'm like, they do that for really rich Browns players. That's kind of cool. It's right down there. But anyway, right next to him is my friend Pete. And Pete invested in a number of my fix and flip deals. And, when we got out the opportunity to invest in the Albany deal, Pete sort of ignored it, not knowing. And then like a week after we closed that big deal with you, he finally looked at all the docs in the video, and he was like, "Damn, I missed it." And so we went over here to Pomeroy House. You know the Pomeroy. We had lunch out there at the Pomeroy, and Pete's like, "Well, I've got some money liquid, got a couple $100,000, and do you have any more of those apartment deals, like, in your pipeline?" I'm like, "No, we don't have anything right now." So he, put some money in our fund and this and that. But he was like foaming at the mouth, right? Yeah. Because I had proven to him over time that I was a good operator. I'd proven to him that I brought other good operators like you, Tim, to the table. And now it was like, oh my God, I can have some equity in perpetuity. So you got to kind of have that. If you can be an operator that has experience, check the box. The deal just makes sense, check the box. Pay some pref return so the investor feels like they're beating the market, check the box. And then give them a little bit of juice in the back. I really feel like that's a home run offer. It doesn't matter if it's a fix and flip, an apartment, commercial deal, a portfolio of rentals, whatever. You follow that. You just can't be stingy. You gotta give up, build long-term relationships with people.
Yeah, man. I whenever I'm asked about private money, I'm always like, as an investor into other projects, I'm looking at three things, right? I'm looking at what is the asset, and like you're talking about, Josh, that's probably the least important of all those things. Hey, I know it's real estate. I know it's bad at the right price point. Like that's all important stuff. But of the three that I'm about to name, the asset is probably the least important. But they do want to know what that is. Two is the return. Is the reward worth the risk? And what kind of return does that look like? Can I have a predictable return along with some upside potential? What are the tax benefits? What is all that stuff? Are there advantages from a tax standpoint? And what does all that look like? And how does it all spell out for me? That's a big deal. But the third one that you've alluded to many, many times in our conversation now is what is the character of the borrower, right? Like you have people who invest with you because they know you're a phenomenal operator, that you're a phenomenal steward of capital, that they know that you're the type of person, well, hey, if shit hits a fan, I'll go work third shift. I'll find another way of making money to make sure that you make your money back because nobody loses their money on my watch, kind of a thing. And right. You've conveyed that to your investors in a way that they're super, super confident with you. Dude, I think that, does this person have the fortitude to repay me my money? I think that's the number one question that any investor asks, that if you can overcome that, like you have access to a lot of capital and a lot of responsibility to be a good steward of that capital too. But, being able to convey that sort of character and that sort of credibility to your investors is critical in raising money, and a lot of times it's setting a track record. It's doing it a long time and doing it the right way, doing the right thing for a long time. And eventually then you build up that credibility in the business, in the workforce, right? Or in the
Absolutely. And so those guys maybe that haven't done their first big apartment deal yet, or don't have a fund or whatever like we do, or maybe have never done a deal and they catch this interview, the offset, right? Because Tim and I used to be that newer investor, right? Mm-hmm. The offset is when you don't have the experience, you probably have to overpay. You don't get as good of terms, or your interest rate is just much higher. I've told this story many times. My first real private lender was my brother's mother-in-law. And she was recently divorced, and she was at the gym, and she's working out, getting back in shape. She's on the elliptical, and she's kind of back in the market, right? She's dating and stuff, and we start chatting, and I see her up here all the time, and we start talking. She's like, yeah, I see this inheritance. It's not inheritance, but divorce settlement. Got some money, and I started talking about my real estate business, and I had maybe done 2 deals in my lifetime. And we structured a note. She took money out of her self-directed IRA, lent it to me at 18% interest for 5 years on a 5-year note. But she lent me $60,000, and I paid her 18% interest, Tim. So I cut her a check for $10,000 every June for 5 years, and she just loved it. I mean, and I had to overpay for that capital because I didn't have the experience. And even though I was, like you said, I was going to be a steward of her capital, I hadn't proven that in the past. So in that case, sometimes you just got to overpay. Mm-hmm. Give somebody 50% of your deal if you have to. Yeah. If you've got just to get the money, because I don't care about the first deal, the second deal. What I care about is, your $50 million portfolio. How do you get $50 million, $100 million portfolio? sometimes you got to give up quite a bit at the beginning to earn people's trust.
Dude, I love it. And it goes back to, dude, like when I got started, I gave up 70% equity in my first 250 deals, 250 deals that I did. Cause I knew I needed to build a resume, right? I need to get enough deals under my belt in order to be able to then go posture up with banks and lenders and sellers and do all those things. And this is not a short-term get rich, right? Real estate is a long-term get wealthy kind of an asset. And it goes back to, and you got to do deals, do a lot of little deals with your investors as well, because when the time comes where you need them to pony up because your back's against the wall and somebody else bailed, like you and I, dude, we did a couple deals, 2 years ago, that were, I don't know, 150, 120, 100, whatever, $200,000, some small deals. And then I bring you a deal and you raise $1 million for one of my projects. Then you raise another 1.4 million for another project. Then we just raised another 800 grand for another one we just did. So,
right.
But if we didn't do those little deals, would you have had that confidence in the operator? You know, it maybe not, but it helps breed that confidence, right? So do a lot of little deals, pay well, overpay, pay on time, pay early, you know, and get in with a lot of different investors, a lot of different lenders. And we see this with a lot of active operators, of going through this phase. Like, you know, they start out as a broker, then they start wholesaling, and then they start flipping houses, and they buy some rentals, and they're single family rentals, and then small multifamily, and they get into apartments and commercial. And there's this transition that they go through in real estate. And I think lenders go through the same thing. They lend on a single family house, and then they realize, like, there's got to be something more. Is there something else that I can get into? Oh, great. There's multifamily. There's rentals. There's larger multifamily. There's bigger apartments and commercial real estate. And they go through the transition and the progression through their life cycle too. And it's and just knowing, you know, where they are and about timing and all that other stuff. And timing is one thing that we haven't talked about, which is a big deal. You know, how often do we go and talk to somebody that's like, dude, timing's just not right. If it was 30 days ago or 60 days from now, I'd have more money, more liquidity. And so a no is not always a no. What I found in private money, it's just maybe it's a no right now, or now it's a not yet kind of a thing, right?
Well, Tim, I mean, just to that example, you know, our friend Brandon, who's got a lot of money invested with me and has invested in our apartments with you and all that stuff. You know, I met Brandon in 2015. My friend Sean, who's been a friend of mine since second grade, says, hey, you know, my friend lives down on Trump National Golf Course in Charlotte, and let's go down there over Memorial Day weekend. Let's play some golf, just hang out. And, you know, oh, by the way, these guys do really well. So you might be able to raise some money for your real estate stuff, but well, let's just go down and play. So this is in, you know, May of 2015. And long story short, I met with Brandon, talked to him, went to dinner that night. We ended up having a few too many cocktails. I ended up crashing in Brandon's, you know, spare bedroom. Sean crashes there. We're hanging out. Get up the next morning, take a flight back home. Just stayed in touch with Brandon for nearly 2 years. Probably quarterly, sent him a newsletter. Probably monthly, would shoot him an email, a text. Would just put some deal flow in front of him, like super not aggressive, very passive. Not needy, not desperate at all, even though I could always use the money at that time. And finally, you know, in 2017, Brandon comes in, kind of tests me out with about 70 grand. And then fast forward to now, you know, Brandon's probably in with us for $500,000, $600,000, $700,000 in multiple deals. So, you know, a no now, like he didn't really say no in 2015. It was more like, let me get to know you kind of thing.
Mm-hmm.
But I always stayed, like I said, just in that 5-step process I discussed earlier, is that multimedia marketing approach. I just kind of stayed in touch in front of Brandon, even though I wasn't calling him, I wasn't bugging him. Physical newsletter, email, invited him to a couple webinars. And the guy keeps saying, hey man, like, I don't need your money, but I could use it. I could use your money, but I don't need it.
Mm-hmm.
And eventually he got comfortable, and then it just opened up and opened up and opened up. And to that point, you know, if you've got the cojones, right, even when you're new, people are always going to ask you, what's the minimum? And I learned a long time ago, we set with our first fund, our minimum was 10 grand. Well, you know, guys that were multimillionaires, what would they say? Hey, what's your minimum?
Yeah.
I love the idea. What's your minimum? That's 10 grand. Okay, great. Here's 10 grand.
Yeah.
Oh, dude, you could give me $500,000. Don't give me 10 grand. So just, investors will go bottom seeking to test the market. So just piece of advice for any of our listeners, if you do a private placement, you're raising money for your deals, raise your minimum. You can always say the minimum's 100 grand, 250 grand, but you always have the authority to accept less if you want to.
It's a great
set
point.
the minimum high. Have the cojones to just ask for a lot of money. And the guy that just like, I'll give you 10 grand, he'll give you 100, he'll give you 200, he'll give you 500 if you just ask for it. And you can always say, I'll make an exception and let you come in for less.
Yep. Dude, that's great advice, man.
Real world example.
All you gotta do is put it out there, dude. That's good stuff. Josh, this has been amazing. I appreciate all the insight and all the value you've given, man. We got to wrap up. Can you share your contact information? Like, what's the best way that people can get a hold of you? If anybody wants to, if you got a single family fix and flip type business, Josh is a great resource for you and his fund to invest in those projects and become your primary lender on those. He's got one-off deals. And then Josh and I work a lot together on some apartment buildings and the Legacy Wealth Fund that we're working on together as well. So there's a lot of different ways that we can do business together and that you guys can do business with Josh. And so, Josh, can you share your contact info?
Yeah, you bet. So a couple of websites. So people are looking for debt financing. Our website is freelandlending.com. We have a private equity fund that is what's called a 506c fund, general solicitation. That's freelandacceleratedfund.com. And, I'll just give everybody my cell phone number, man, because if they want to reach out to me, they can reach out to me direct and say hello. Just understand if I don't get back to you right away, either I'll get back to you or my assistant will get back to you. I'm fanatical about creating relationships. I'm fanatical about follow-up. And I will get back to you. If it's a text message or a follow-up. So my personal cell phone number is 216-233-5448. And Tim, give everybody a tip. I was speaking with Kevin O'Leary from Shark Tank. He came to one of my events and talked a couple years ago. And we were talking in the back room after, and Kevin said, look, with all my businesses, I've got two cell phones. I've got a personal cell phone that only my friends and family, my close friends and family know that number. And then I have a second cell phone that I give out to everybody. I've literally given it out to tens of thousands of people. And people can reach me, and I want them to know, whether they're investors, whether they're borrowers. For him, it's different business owners, different vendor clients, different investors in his businesses. He said, I want them to know that I'm accessible. I'm not just going to take their money and disappear.
Yeah, I'm not trying to hide, right?
Right? I want to be accessible. And that accessibility gives them a sense of trust, give them a sense of control. And so, I'm baffled by how many people I've given my cell phone out to who don't call me.
I know, right?
Actually, right? So I'm not afraid to give it out. If you call me, I'll reach out to you. I'd be happy to connect with you on Facebook as well. But, people can reach out to me directly and we'll be happy to talk to them.
Awesome, brother. Dude, I appreciate you. Appreciate all the value you brought to the show, to me. I appreciate our relationship and look forward to continue building legacy wealth together, bud.
Yeah, I appreciate it too, Tim. I had a great time today. Thanks for having me on.
All right, guys. Josh Cantwell, another episode of Legacy Wealth Show, and I hope you guys have an awesome day.